And welcome back, and here's your latest housing market update, and thank you so much for joining me in today's video. There's actually a few reports I want to go over in today's video, and the first one is this one right here, just posted today at the time of this video, which is April 11th, according to the Mortgage Bankers Association, or the MBA. And they say here that mortgage credit availability increased in March. In other words, the lending standards actually got a little bit looser in March compared to February of this year. And it says here credit availability increased in March according to the MBA. It didn't increase by much though. Look at this. Their MCAI, which is their credit availability index, their MCAI, only increased by 0.4% in March compared to February, which, by the way, a rise in their index here is indication of loosening credit standards here, but only an increase of 0.4%. So the current levels we have right now regarding the availability for credit for people looking to get a loan to buy a house is currently at the lowest levels since approximately 2013. So for example, according to Joel Kahn, who's the MBA's vice president and deputy chief economist, he stated the following: mortgage credit supply increased modestly in March, but remained close to its tightest levels since 2013. With the spring home buying season underway, lenders are grappling with the threat of a recession and tighter overall financial conditions following the recent bank failures. The supply of government mortgage credit, which includes, of course, FHA and VA loans, which is very popular amongst first-time home buyers, actually decreased for the third time in the past 4 months, which could potentially hinder first-time home buyer activity. There was a small increase in credit availability for jumbo loans though. So jumbo loans are for high balance loans, and that's what's called a jumbo loan. However, though, we expect banks, which account for most of the jumbo market, will tighten jumbo lending criteria in response to recent challenges in the banking sector. This is actually exactly what Fannie Mae is forecasting as well. Here's what they had to say here. A single-family mortgage lending in the jumbo market may tighten significantly, leading to fewer home sales in those related regions and markets. Unlike conforming loans, not a jumbo loan, which are largely financed through mortgage-backed securities or MBSs via capital markets, the jumbo market space is almost entirely funded via the banking sector. And some regional banks are more concentrated in the jumbo market space than others. Therefore, this happens, the markets that are going to be most impacted by this are areas that are more expensive than others. In other words, the markets in which they have a higher concentration of jumbo loans. And going back to the MBA's report right here, they actually broke it down by each of these loan types for their index here, or their credit availability. So the credit availability actually increased 1.4% in March compared to February for jumbo loans. So for conventional, it increased by 1.1%. But for government loans, that would be FHA, VA, USDA loans, for example, that actually decreased by 0.2% in March. And by the way, of course, an increase in their index means that lending standards are loosening. And of course, a decrease means that lending standards are actually tightening up. And again, overall, it'll increase by 0.4% in March. So here's a really good chart showing their index going back to 2011 here. The current levels right now is more or less on par with 2012 and 2013. In other words, the tightest lending standards we have going back to approximately 2013. What of course this means is that lending standards are getting tighter on par with 2013's levels, the lowest levels going back to approximately 10 years, which of course means that it's getting actually more challenging to get a loan approved by lenders right now. Now, here's another way to look at their index going back to 2004, which is really eye-opening here. Again, the current levels right now, more or less on par with 2013, but at 100.5, their current index, the lower the number, the tighter their lending standards are. Look at this, 2005, 2006, their index was over 800, absolutely insane compared to the levels we have right now. Also, as I noted in my previous video for you guys, out of all the home buyers right now who have locked in their rates in order to buy a house or for people who are refinancing their current mortgages right now, the average credit score right now is 725 nationwide. And I mentioned that because the average credit score right now is much higher compared to 2006 and 2008, when obviously lending standards back then were extremely loose, especially compared to what we have right now. Also in today's video, I want to share this with you guys as well. This is based on a monthly survey that Fannie Mae conducts regarding sentiment regarding our housing market in the US here. It says consumer confidence in housing or in the housing market remains near historical lows. So for March, the index, which is their, what's it called, their home purchase sentiment index, or their HPSI, increased in March, but it still remains only slightly above its all-time record low that was set late last year. So according to Fannie Mae's vice president and deputy chief economist, he stated the following: despite the recent banking turbulence, the HPSI, again their home purchase sentiment index, increased modestly in March, although it still remains near historical low levels. With the spring home buying season upon us, a large majority of consumers continue to believe it's a bad time to buy a house. Shocker. Homeowners sharing this belief frequently cited unfavorable mortgage rates as the primary reason for their pessimism, further corroborating the often discussed disincentive or this lock-in effect amongst current homeowners who do not want to sell and give up their historically low rate. By contrast, surveyed renters once again indicated that high home prices are their primary concerns for buying a house. This last sentence here really hit home for me because a lot of you guys who watch my videos and comment on my videos say that the main reason why you are not buying a house right now is due to high home prices and also the fact that prices have skyrocketed over the past few years, and not due to the fact that rates went from 3 to 6.5%. You're more concerned about high home prices than higher rates. And of course, please leave me a comment below if you guys also believe that. That's just something I kind of been hearing more and more lately, that a lot of people are not buying houses right now due to the fact that prices are still very, very high. And going back to Fannie Mae's report here, here's their actual report for their monthly survey that they actually do. Of course, based on their home purchase sentiment index, which is an index designed to track consumers' housing-related attitudes, intentions, and perceptions using 6 questions. So overall, their index was at 61.3 this March, lower than May of 2020 when we had more or less stay-at-home orders across the United States, which is really telling. So at 61.3, even though it increased compared to last month, the current levels right now are more or less on par with 2011. In other words, on par with the lowest levels of consumer sentiment regarding the housing market in at least the last 10 plus years. And one of the reasons why their sentiment is so low right now is this right here. Only 20% that responded to this March survey here said it was a good time to buy a house, whereas 79% said it was a bad time to buy a house. In regards to is it a good time to sell a house, 58% said it was a good time to sell, whereas 40% said it's a bad time to sell. Also, in regards to their outlook regarding home prices over the next 12 months, it was split. 32% believe that home prices are going to increase over the next 12 months, and 31% believe that home prices are going to go down in the next 12 months. In regards to mortgage rates over the next 12 months, 51% believe that rates are going to increase over the next 12 months. Only 12% believe that rates are going to decrease. In regards to job loss concerns over the next 12 months, 78%, or the vast majority, are not concerned about losing their jobs, whereas 21% are concerned. Here's also a detailed chart showing the percentage of respondents who said it's a good time to buy or a bad time to buy a house right now. So again, 20% right now said it's a good time to buy a house. 79% said it's a bad time to buy. Also, in regards to only 20% who believe it's a good time to buy a house, this is not too much higher than the 17% that we saw from just a few months ago. However, though, having said that, 20% is still very, very low. So for example, back in February and March of 2021, approximately 53% of these respondents said it's a good time to buy a house. Also back then, 40% said it's a bad time to buy, and that increased now to 79%. So please leave a comment below with your biggest takeaways from today's video. Also, if you guys got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Of course, I appreciate you. Hope you guys have an awesome day. Look forward to seeing you on the next video.